Hello students, welcome to our channel CA Made Easy. Take a deep breath and just settle in. This is the part 5 explanation of our chapter on the mathematics of finance. And honestly, we're entering the ultimate boss battle of this topic today. You've cleared the earlier stages, but today we're facing the most advanced concepts straight from the ICAI material. So are your calculators ready? Shuru kare? Shall we begin?
Okay, so here is our agenda for today's session. We've got 1. Perpetuity, 2. Net present value, 3. Interest rates, 4. CAGR, and 5. Depreciation. We're going to slowly, carefully master these 5 ninja tools. Mastering these is absolutely going to level up your exam readiness. Got it? Understood? All right, let's move forward. Section 1, Perpetuity, the infinite cash flow. Think of this as an anime-style power-up that literally lasts forever. It doesn't stop and it never runs out. So perpetuity is basically an annuity where the periodic payments, or receipts, begin on a fixed date and just continue indefinitely, forever. Now the core logic we really need to understand together is this. Because the principal is never actually repaid, there's no present value for the principal itself. The price of perpetuity is simply the coupon amount divided by the discount rate. It's infinite cash flow. Let's look at ICAI Example 42 together. Assuming a discount rate of 7% per annum, how much would you pay to receive rupees 50, growing at 5% annually forever? Just pause for a second here. Let's figure out the secret technique we need. We've got our cash flow, our discount rate, and our growth rate. And the answer is rupees 2,500. Let's break down that technique. The formula for the present value of a growing perpetuity is R divided by the difference between I and G. R over I minus G. Here, R is 50, our interest rate I is 0.07, and our growth rate G is 0.05. So 50 divided by, in brackets, 0.07 minus 0.05. That's 50 divided by 0.02, which gives us exactly 2,500. Just make sure this mathematical logic is crystal clear in your mind. Section 2. Net present value, or NPV. Excellent work so far. Let's transition right into the next boss stage. For chartered accountants, this right here is the ultimate investment decision tool.
ध्यान से सुनो, ये concept exam के लिए crucial है. Listen carefully, this concept is absolutely crucial for the exam. NPV is all about the time value of money. See, a rupee in your pocket today is worth much more than a rupee you might get tomorrow, right? When a company invests in a capital project, they look at cash flows over many years. NPV basically brings all those future rupees back to today's value so we can see if the investment is actually worth making. To defeat an NPV problem, we use this step-by-step combo move straight from our source material. Step 1. Determine the net cash inflow for each year. Step 2. Select your discount rate or cost of capital. Step 3. Find the discount factor for each year. Step 4. Multiply the cash flows by these factors to determine your present values. And finally, Step 5. Total all the PVs and subtract your initial investment. Pretty simple, right? Okay, let's test that combo on example 43 together. We have a project requiring a net investment of rupees 100,000 today. It gives us cash inflows of 55,000 in year 1, 80,000 in year 2, and 15,000 in year 3. Our cost of capital, which is our discount rate, is 10%. Grab your calculators, students, prepare your fingers for battle, and let's set up the table. Now, what's really interesting about this slide is how you can physically see the time value of money at work here. In year 1, the factor is 0.909, shrinking our $55,000 down to $49,995. By year 3, the factor drops to 0.751. The future cash flows are shrinking step by step as we pull them back to year 0. When we add up all those positive discounted cash flows and subtract our initial $1,000 outflow, we get a net present value of $27,340. And this brings us to the golden rule of CA investment decisions. If your NPV is greater than 0, the investment is earning more than the cost of capital. You accept the proposal. If it's less than 0, you reject it. Since our NPV of $27,340 is proudly positive, we confidently accept the project. Section 3. Nominal, real, and effective rates. Brilliant. Now, let's shift our focus to this third section. Examiners really love to lay tricky traps here, so let's maintain our concentration. Let's quickly compare nominal and real interest rates. The nominal rate is simply the stated rate on paper, but the real interest rate,
That's the truth after inflation. The formula is nominal interest rate equals real interest rate plus inflation. Logically, inflation eats away at the purchasing power of your money over time. The real rate tells you what your money is actually earning in terms of real-world value.
Then we have the effective rate of interest. This is the actual equivalent annual rate when interest is compounded more frequently than once a year, like quarterly or monthly. I really must warn you, frequent compounding periods make loans significantly more expensive in reality than the stated nominal rate suggests, so always check the effective rate before signing anything.
Section 4, Compound Annual Growth Rate, or CAGR. We are now entering the fourth zone. Let's master this, not just for clearing your ICIA exams, but because it's a fundamental tool for real-world business analysis and stock market tracking.
So, the crucial point is this. CAGR is the smoothed, annualized gain. In the real world, revenues might jump up 20% one year, fall 5% the next, and spike 30% the year after. It's too volatile to understand easily. CAGR magically smooths out these wild ups and downs to give us one clear, single average growth metric over a specific time period.
Let's tackle this example directly from the source material. A company's revenues were 100 in 2013, and they grew to 210 in 2016. What is the CAGR? The time period, N, is 2016 minus 2013, which is 3 years. The formula requires us to take the ending value, divided by the beginning value, and raise it to the power of 1 over n. It looks pretty complex on paper, v of tn divided by v of t0, whole power 1 by n minus 1. But don't worry, here is the ultimate CA calculator trick for complex exponents. Keep your pace slow and just follow me. Step 1, type your ending value, 210, and divide by the beginning value, 100. You get 2.1. Step 2, to solve for the power of 1 over 3, we use our root keystrokes method for the nth root on your standard calculators. Once you extract that root, step 3, subtract 1 from the result and multiply by 100 to get your percentage. Now, if you followed the steps correctly, your calculator screen should show 27.74%. Shabash, well done! We have successfully calculated a compound annual growth rate of 27.74% over those 3 years. Definitely keep these applications in mind for your revision notes. Why do we even learn CAGR? Well, it's to calculate the average returns of mutual funds, to forecast future sales based on historical trends, and to compare the performance of totally different assets, like stocks versus bonds, on an equal, smoothed-out playing field. It is incredibly practical. Section 5, Depreciation. And here we are. Welcome, students, to the final boss stage of the Mathematics of Finance chapter. Let's face question 9, a very tricky ICAI objective question. A machine worth rupees 490,740 is depreciated at 15% on its opening value each year. When will its value reduce to rupees 200,000? Notice what's happening here. This question tests our grasp on compound interest, but we are effectively running the engine in reverse. Here is our final finishing move. Step 1, write down the diminishing value formula. A equals P times 1 minus I to the power of n. Step 2, substitute. Our target amount A is $2 million. Our principal P is 4,090,740. Our rate I is 0.15. So $2 million equals 4,090,740 times 0.85 to the power of n. Step 3, now let's use our options. Plug the multiple choice options for n into your calculator using trial and error to find exactly how many years and months it takes for 0.85 to the power of n to balance the equation. It's all about smart calculator skills here. And with that trick, we have officially defeated the final boss. Take a deep breath and ask yourself, are you ready to conquer the mathematics of finance exam? Because after mastering perpetuities, NPV, CAGR, and depreciation today, you absolutely are. Bahut badhiya kaam kiya aapne aaj. You did great work today. Keep practicing those calculator tricks, stay confident, and best of luck for your exams.